3 fundamental reasons for putting your money into the stock market. Number 1, reach financial independence. Number 2, cut out the middleman and manage your own investments. And number 3, because buying shares is the fastest route to wealth. The first reason for investing on the stock market is financial independence. But what is financial independence and how do you reach it? Financial independence is that point where the income from your investments is greater than your monthly salary. It's that point where you are independent of the need to work and can retire comfortably. So how do you reach financial independence? Well, at the moment, the high probability is that at least 90% of your income comes from your salary, which means that you are exchanging a great deal of time for money. In this life, there are only 2 ways to make money. You can work for it, or you can make your money work for you. And it is an unassailable fact that nobody has ever reached financial independence or become rich by working for a salary. Achieving financial independence means reversing those figures so that at least 90% of your income comes from your investments. Ultimately, you want your investments to take care of most of your income so that when you retire, you don't have to worry about how your expenses will be paid. Achieving financial independence is actually a question of when you would like to retire. And this, of course, depends on how effective you are in your investments. So why cut out the middleman? Well, here are some facts about other investments which may help you to understand why the share market is the best place to put your money. Only 1 in 5 unit trusts manages to outperform the indices of the sectors of the markets in which they compete. Never has it been better to buy a pure endowment policy than to buy the shares of the company that offers the endowment policy in the open market. Insurance policies also completely lack liquidity. You can be on the phone and sell your Liberty Life shares in 2 minutes and the money is in your bank account within a week. Getting out of an endowment policy is both difficult and expensive. Rather be Donnie Gordon's partner than his client. So now you may ask the question, but isn't having a middleman less risky? The risks involved in buying shares are either that you buy shares in a bad company that has no prospects, or in a good company but at the wrong time. These risks are real, whether you are a spectator in and out of the market every few weeks, or an investor investing in the long run. Either way, there is always a chance that you may buy into the wrong company, or buy at a bad time, or both. To protect yourself against major losses, you should adopt a stop-loss strategy. A stop-loss strategy is like the seatbelt you put on when you get into your car. You do not put it on because you are expecting to have an accident that day. If you were expecting to have an accident that day, you would not get into your car in the first place. No, you put on a seatbelt to protect yourself against the unexpected, like if someone jumps a robot in front of you. The idea is very simple. Once you have decided to buy a share, you should mark off a price, say 10% below the purchase price, which will be your stop-loss level. For example, if you intend to buy a share for 10 Rand, set your stop-loss level 10% below that, at 9 Rand. If the share price drops, when it reaches the stop-loss price, you sell, because unfortunately your decision was wrong, or at least at the wrong time. It is important to acknowledge your mistake and in so doing minimize your losses. But what if the share goes up? Let us suppose that you are right and the share goes up. Let's suppose that it goes up to 15 Rand. Then we recommend that you keep your stop loss at 10% and adjust it to 13 Rand 50. Now if the share turns and starts to fall, when it reaches 13 Rand 50, you sell. Because the one rule about stop loss levels is that they never move down, only up. So a stop loss works like a ratchet. It only goes up. Let us explain this a little further. The JSE Overall Index is an average of the shares trading on the JSE. From 1915 to 2015, this index has been rising at an average of approximately 13.8%. Of course, it did not rise in a straight line. There were booms and busts, but the average growth over that whole time was 13.8%. Now imagine for a moment that you are a complete beginner, and so you decide that you are going to choose your shares completely at random. You're going to stick the price page of your newspaper up on the wall, tie on a blindfold, and then throw darts at it. Where these darts land, those are the shares that you will buy. If you do that, then do you agree with me that half of your selections will be above this line and half will be below? This must be true because the index is an average of the shares from which you are selecting. So, if on the shares that outperform the index you can make 300, 400 or more %, but on the shares that underperform the index you cut your losses at 15%, then can you see that even if you choose your shares at random, so long as you have a strict stop-loss strategy, you must outperform the index. In order to keep up with developments so that you don't miss out on golden opportunities, it is important that you make a commitment and that you have a good charting package. You need to spend a regular amount of time, say 30 minutes each day, studying the market and your investments, and then using this knowledge and your software to focus on your goal of becoming financially independent. Soon you will quickly find that that half an hour becomes the most profitable half an hour of your day, and that your goal of financial independence becomes a reality sooner. Think of playing tennis and trying to hit the ball wearing a blindfold. Your chances of making money off the share market without following the market every day are about the same. You cannot hit the ball unless you are watching it. The third reason that you should put your money in the stock market rather than somewhere else is because investing in the share market is the fastest route to wealth creation in the long term. One study over 40 years shows that 1,000 Rand invested in a fixed long-term deposit in a bank would have been worth 45,901 Rand 40 years later. That same 1,000 Rand invested in a spread of shares at the same time would have been worth 843,703,000. That's more than 18 times the return on fixed deposits. So by trading share cycles, this performance could have been substantially bettered. It is also true that blue chip shares on the JSE have doubled their value roughly every 4.5 years for the past 30 years. Here you can see that the chart shows that EOH was 605 cents on the 16th of February 2009, and by the 7th of August 2015, it was 17,824 cents. That's a growth of 2,844.3% over a period of 6.5 years. Obviously, not all shares perform like this, but the fact of the matter is that 1,000 Rand invested in EOH at the start of this period would have been worth 28,443 Rand by the end, less than 7 years later. And this growth excludes the regular dividends which the company paid out to shareholders over that period. EOH's dividend per share was 30 cents in 2009, 36 cents in 2010, 48 cents in 2011, 70 cents in 2012, 90 cents in 2013, 120 cents in 2014, and 150 cents in 2015. As you can see, their dividend has been rising steadily for the past 7 years, which obviously accounts for the incredible performance of the shares. So you can see that investing in the share market can be extremely lucrative. It just requires you to be patient and diligent.